old guy and you retired with all your money in your 401k, not a good move. I'm sorry.
Yeah.
You got to get some of that out of there, because if it tanks, I know I lost, $300,000-$400,000 in 2008 and 9. It took 7 to 8 years to make that money back.
Wow.
Okay. No. I don't want to have that type of exposure.
No.
And if you're in your retirement years, you don't want to wait 8 years for it to come back. Because not only you lost the time value of money, the appreciation of what that money, that $300,000, what would that have earned at 10%? Think about that over 8 years. I've lost another couple $100,000 in lost value. And Wall Street doesn't tell you. They don't think, you don't lose any money unless you sell it. Well, I did lose money. 300, 400 grand for 8 years was not there.
Welcome back, everyone, to the Passive Road to Retirement podcast. I'm your host, Andy Jarrett. Today, we are joined by Matt Hansen. Matt is a retired corporate executive that transitioned to full-time real estate investor. His investment portfolio includes over 2,000 units of multifamily apartments located in Texas, Tennessee, and Florida. He's passionate about helping others avoid the volatility of the stock market by passively investing in real estate. Matt, welcome to the show.
Thanks so much, Andy. Happy to be here.
Yeah, great to have you here. So for those who don't know your story, maybe you can just kind of give how you transition from, full-time corporate executive to real estate investor.
Yeah. So I retired about 2 years ago. But before that, probably 6 years ago, I really got heavily into large multifamily. Before that, I did some fix and flip, over the 33 years or so. My wife and I did a dozen houses or so. But about 6 years ago is when I got into large multifamily syndication. And as a corporate guy, I wasn't really allowed to advertise I was doing it. So I would run deals from the letter of intent to the close behind the scenes. I would do the marketing and I would do due diligence or whatever, that type of stuff.
Yeah.
And then about 2 years ago, I retired. Now I can openly talk about, hey, this is what I'm doing. But it was great though, and I also did tons of limited partner passive investing to begin with.
Sure.
And that was really powerful because I found out, okay, what do I like and what don't I like with these deals that I'm investing in?
Yeah.
How are people managing them? How are they treating me?
Right.
And I always make sure I remember, when I was a new person and I was investing and they didn't tell me distributions wouldn't start until 6 or 8 months or a year after you put your money in.
Right.
That was my first. Nobody told me, you're not going to see distributions until we renovate the units and now we have cash flow. They never said that. I'm thinking, where's the money? So it was a really good experience. So that's kind of how I got into it. Gradually as limited partner, now I've run lots of deals. We're doing big deals in Florida, Texas, and Arizona. We're looking at Arizona. Three of the best markets to passively invest in real estate.
Absolutely. Nice. Now, why are you picking those markets? More like migration patterns, or what do you look at when you pick those markets?
Same thing you do, Andy.
Yeah.
Is that we look for population growth and employment growth.
Yep.
So Florida, where you live, probably between that, Texas and Florida, those are the top 3 markets. I think pretty much everyone will agree. In terms of affordability too, that's where people are moving. That's where employers are moving. East Coast and West Coast people are moving. The East Coast people are moving to Florida. The West Coast people are moving to Arizona, Nevada a little bit, and Texas. So, we follow where the people are, where the population is. That's the number one population and employment for large multifamily apartments. Because when you have a 227 unit, you got to make sure there's people moving into that town.
Yeah, exactly.
And we do.
And we
nobody, we can't afford to be, but we do the stress test. So we know, okay, 67% vacancy or occupancy, we're still breaking even.
Right.
So we take a look at that. So that's why we like those markets.
Nice. And Florida, as you know, no state income tax, which we love, right?
Very good. Very nice.
Yeah.
Yes.
So Matt, how has passive investing, passive investments, the cash flow, how has that affected your family life, I guess, or has it made a significant impact on, your day-to-day life?
Yes. I think the cash flow isn't typically significant for like $100,000 investment's going to kick off, $3,000 to $5,000 a year.
Right.
But the big thing is when we refinance an apartment complex or when we sold it, those 2 capital events, that's when the big payoff. So we have 3 apartment complexes in Florida. Well, you're a partner in one of those.
Yeah,
you know. So the Jack's 3 deal that we did, we just sold all of them and doubled our investors' money. And again, I'm not a financial advice. I'm not soliciting. I'm not a tax professional or legal advice or anything, but just this is some past performance, a case study, if you will. Our investors, if you invested $100,000, you get $202,000 back from those properties after 32 months. Our business plan was 72 months, but we were able to accomplish that business plan and blew it out of the water. I think we're 32% returns. So we chose, okay, in 3 years, in 32 months, we're going to give all of our money, we're going to sell it, give everybody's money back and all the profits versus hanging on to it for another 3 years. It's law of diminishing return. It's velocity of money. You've earned that. We have a fiduciary responsibility to our investors. We did it. Let's give you your money back now. Now you can take that. Now you have twice as much to invest, pay for your kids' college or whatever you want to do with that money. Go on a big vacation. So that's really powerful. It really is. As a limited investor, I love it. But it's usually the big capital events when you're selling it or refinancing it is the big bump that you get. And that's what we all look for.
Yep. And it can't be life-changing, double your money like that, especially in that kind of time frame. What a great investment.
Can't do that in Wall Street, can you? Is anybody doing not legally?
Not securely, right? Or,
Yesterday, I was presenting at the local real estate. I live in Michigan now. I moved back to Michigan for family reasons.
Okay.
Yeah. So I was down there. I never got to see you.
I know. I haven't seen you in a while. Yeah.
We were probably 4 hours away. But anyway, so I'm in the Midland, Jackson, and I was a guest speaker yesterday. And I was telling that. And I said, well, you can't do this on Wall Street. And somebody yelled, yeah, you can if you do it illegally. And I said, well,
insider trading.
We're not doing Ponzi schemes and stuff like that. But I got called out on that. So, legally, I have to say, legally, you can't do that in Wall Street.
Yeah. Well, you've been obviously, in real estate a long time, done a lot of deals. So do you have, most people typically have one deal that maybe didn't go as planned or something they weren't expecting. Do you have any, any story you can share with our audience about?
I can. It was actually my first passive investing deal. So almost 6 years ago. And I knew the main partner of the deal, the sponsor, the general partner. And so he's the guy I invested with. Well, after 6 months into the deal, we put my money in. It was $100,000, and he decided, you know what? I don't want to do multifamily anymore. I'm going to do triple net leases and commercial properties. So he left the GP, and the other two partners were newer people, and I kind of knew who they were, but they were younger people, young professionals. Nothing wrong with that, but they ran it to the ground within another 6 months. They weren't following for the property manager, and then they had a capital call. They said, okay, by the way, we need another 12,000 from all investors, or we're going to reduce your equity in the deal. So I said, well, I'm not going to give you guys another 12 grand. I don't trust you at all. You haven't performed well. So I did it, and they diluted my shares, which was fine. They did end up selling it last year, and I think I made 62,000 on it, but I should have made 100,000 on it.
Right.
So that was a $40,000 mistake. Because the lesson is, look at all the general partners. Most importantly, the asset managers. My buddy was the guy I knew was going to be the asset manager. So it's the asset manager. Who are those asset managers? And it's usually one or two people, usually two, you want to back up. Vet those two people really well, because they're the ones you're married to for the next 6 years. They're going to run that asset on the day-to-day. So look at the asset manager, look at their track record, find out who their backup.
Yeah.
Well, I learned the hard way.
Good advice. Now, when you're looking at, GPs and who's running it, is there anything you typically do? Any kind of, background checks or anything, or what do you look for?
Well, you and I are in the same mastermind, the same group. So we're all kind of pre-vetted. We're mostly all high net worth individuals. And like you, I've known for 3 years. I would invest with you, no question. I would partner with you 100%, Andrew. You know that.
Exactly.
So that's really, I think it's easy from that perspective, because I only partner with people that I have already known for 3 years. So I know their true colors. I know how they behave. I know how they react if things don't go quite well. That's where you really learn. And early on, I did have some partners that when things went sideways, they didn't have your back. They didn't know what they were doing. They really weren't that strong. So I think really is you need to know somebody. Just meeting them once or twice. But like you, I know your track record. I know you're a stand-up guy. That's the only people I partner with now. And it's great because we're in a tribe that, like, I'm partnering with a deal in Florida. I've got a friend in Arizona in the group that I'm going to partner with him as soon as I can, as soon as I finish the 2 deals I'm working on. I want to partner. So I've got that opportunity. And these people are already experts like you and I. They know what they're doing. So I know that things aren't going to go sideways. So that's the benefit of having a tribe like we do, is that we all kind of know each other well enough and have seen your performance, and your communications are great. Andy, and stuff like that. So I think that's the thing. But it's the same thing with passively investing. If you're going to passively invest with somebody and they're not replying to you quickly, or if you have lots of questions and they're getting impatient with you, or they're not following up, that's a sign that, okay, maybe not want to invest with them. If they're not forthright and sharing everything with you in a timely fashion, that's a pretty good indicator that, you probably shouldn't be investing.
Right. Yeah, I totally agree. Especially before you invest your money, like you're saying. And, and I agree likewise. I mean, I'd have your stamp guys. Well, no problem putting money with you. Absolutely. So
thank you.
100%. So it's a passive road to retirement. So I always ask, what would be your top strategy for somebody just getting into real estate, kind of learning, their way around? What would be a good strategy for them to create some kind of passive income stream?
Really, it's if you're retired or if you have a past employer and you have a retirement fund sitting in a 401k or Roth IRA, and I was one of those people, you can take that money and roll it in, no penalty, no taxes, to a self-directed IRA with checkbook control. Now you have control over that money. You can passively invest in real estate, crypto, and other venture capital. And that's what we've done. I had a stack of cash. I was an executive for a Fortune 100 company, accumulated a whole bunch of money in my 401k that I can't touch. I retired early. I can't touch until I'm 59 and a half.
Yeah.
Well, you can take that, roll it into a self-directed IRA, and you would not believe the stuff that we're invested in. It's like I have 20% in the stock market. The other 80% is in, probably 60% is in real estate. And the other 20 is venture capital stuff with some of my other friends. Nice. That, you would not, just all sorts of crazy things that are going to be huge returns. And some of them may not make money. But the fact is that I have control over that money. It's not locked in the stock market where I don't have control over. So I think that's the biggest. If you're retiring and that gives you cash flow, but really just gives you diversification. Because if you're an old guy and you're retired with all your money in your 401k, not a good move. I'm sorry. You got to get some of that out of there, because if it tanks, I know I lost $400,000 in 2008 and 9. It took 7 to 8 years to make that money back.
Wow.
Okay. No. I don't want to have that type of exposure. And if you're in your retirement years, you don't want to wait 8 years for it to come back. Because not only you lost the time value of money, the appreciation of what that money, that 300 grand, what would that have earned at 10%? Think about that over 8 years. I've lost another couple $100,000 and lost value. Wall Street doesn't tell you. They don't think, you don't lose any money unless you sell it. Well, I did lose money. 300, 400 grand for 8 years was not there, that I wasn't earning on.
Yeah.
So don't listen to Wall Street and everything they say. They make money if the market's up or down. They make money off.
Yep.
So I think that's my tip, is really get outside of that a little. You need to get some of your money outside of Wall Street.
Like with syndications, somebody can email you, and find out what's going on. They can't really email the CEO of, Coca-Cola and ask, hey, how are
I'm not going to reply.
Going, right? Yeah. So
no transparency at all what's going on.
Yeah,
exactly.
Yeah. And you have a guide, I believe, a free guide on your website on how to do this too, right?
Yep. It's called Rethink Your Retirement. And it's a 9-minute read. And it's, if you're new to multifamily investing, it gives you a quick overview of what it is, and then talks a little bit about self-directed IRAs. And there's some rules around it. You can't invest in your own things. You can't invest in family lineage, parents or kids and things like that. So there's some restrictions, nothing you can have. You can't benefit from it all because it's still in your IRA bucket. So you can't touch that until you're retired.
Sure. But
it allows you to invest in arm's length away, is what they say, the SEC says, or the IRS says. It can't be a deal that you're managing or actively participating in at all. But that's why I passively invest tons of stuff with my friends' deals, because I can't put it in my own. And that's great. I've already got these relationships. They're pre-vetted. I know they're good deals. I mean, I think we know Keely and her dad, Tracy. I'm 100 grand in a vineyard.
Yeah.
With retirement funds, It's great. It's wonderful.
Yeah, exactly. That's awesome. So now how long does it take, I guess, to transfer your money? I mean, I know how it goes, but maybe you can explain, how it works and how quickly somebody can do that.
Typically takes 30 days or so. So you contact Fidelity. The big companies are really pretty nice about it. Some of the smaller ones, mean, the ones that are multi-billion dollars. Yeah. Those I hear they don't want to let your money go. They're a little bit, they make it difficult, the red tape, but some of the big players, Fidelity and those, you put in a request to have your money transferred. Actually, they'll send you the check. I did this. They send you this huge check. And within 60 days, you need to get that redeposited. You can't use that money. Don't go buy a sports car or anything with it. You got to redeposit into another an IRA, a self-directed IRA. So it usually takes about 30 days for them to write the check. You get it redeposited. Sometimes they'll do a direct transfer. I think Fidelity had to send me the check, and then I had to deposit the check into my new self-directed IRA. 30, 45 days. So if you think you're going to get in a deal, do that early. And so you're not rushing around, oh, the deal's going to close. Well, I don't have the funds moved. So it's about 45 days on average. It's not too difficult. And I've walked investors through this a lot. And I've actually gotten on the phone with I can't talk about accounts, but I'll call and say, hey, you know what? I've got an investor who's trying to get your money out. You guys I'm really nice about it, being a little difficult. What do we need to do to make this happen? And then they'll say, oh, well, you need to fill out this form, this form. So I've actually done that and helped people move their money because they don't want to make it easy. Wall Street does not want to let go of your money. But it's not that difficult. And it's so powerful. I mean, you can 2x your money in 3 years versus, letting it sit there for 30 or 40 locked into a stock or bond that you really don't have any control or influence over. And it's not going to grow like that, particularly with what's going on in the economy right now.
Yeah.
Pretty leery of Wall Street. So not too bad.
Speaking of the economy, there's a lot going on, possible rate hike next week, right? Which I'm sure we'll see. I guess with everything going on, what are you most excited about right now coming up? And is there anything, that keeps you up at night or anything you're worried about?
No, not really. I think there's going to be more opportunities. We were before the show, and Andy and I were chatting a little bit about what do we think the market's going to go.
Yeah,
we see that there's less money coming into large multifamily. So before they were getting 20 offers on an apartment complex, now they're probably getting 10 or 15. And because interest rates are going up, and some private equity or buyers will say, you know what, I need a 15% or 10% return. And others say, oh, I only need a 6% return. So it's knocked out some of the people that say, okay, I need to make sure I'm returning some ridiculous number. So they're not going to come into play because now we're being more realistic and saying, it's 8% return probably, not these 15, 20 that we've seen in the last few years. So the market's softened a little bit, which is good for us as buyers because we are experienced buyers. We've got great track records that we can get deals. We have certainty of close. People like to have us buy their properties because they know we're going to close on them. And we're easy to work with and things like that. So those are intangible things that we've got to benefit because of the experience that we have. So I don't think it's going to be a problem. I think we're going to still be fine with deal flow. It's going to slow down a little bit. And you just got to be critical in underwriting deals to make sure that it's going to be profit. Stress test it really well. We don't know what's going to happen. Nobody knows what's going to happen in the future. Since COVID, all bets are off. Things have always changed. That's why it's key that you're investing with somebody and they all say, this is a conservative investment. Check the numbers. Is it really conservative? I don't know.
Exactly. Now, your investors, what do you think they look at majority of the time? When they're looking at a deal, is there anything they should look at when they're checking underwriting? Any advice you can give on that?
Really, it's the location. First off, the sponsor. We already talked about who you're investing with. That's more important than the deal, really.
Right.
Because if somebody can take a great deal and run it into the ground, like the deal I invested in early on. But really, it's population growth, employment growth. If you're in one of those, and I wouldn't be investing in a super, super small market. I love Michigan. I live here. My friends are here. But I'm not buying apartments here because it makes more sense to buy them in Florida and Texas and Arizona because that's where it's most profitable. So first off, look at the market and again, it's not dummy proof, but if you're in a large metropolitan area and it's a good property manager, good asset manager in place, and the underwriting looks reasonable, and you can take a look at stuff. You can see what the population growth is. You can see employment. You can take a look at crime reports for the neighborhood. Do your own due diligence, like you're saying. You're leading me to that, Andy. Okay, do a little bit of work. Just don't take face value of everything. Do a little. You can Google. Everything is Googleable. Everything is out there on Google. Spend a half an hour taking a look and saying, okay, is this Jacksonville a place I want to invest? Numbers are phenomenal. I know it is. We own so much there. That's the thing is do your due diligence. Don't have to spend hours and hours and hours, but a half an hour of just checking a couple of things. You'll know this is the good market. These are good people. The property managers, they're a good property manager. They're going to be running your asset. Do they have a lot of units? And we're a big player with ResProp, our favorite property manager in Florida. And we got, 2,000 units with. They take great care of us because of that. And they're super professional. They're wonderful. So I think those are the things as a passive investor, do your own due diligence. And if you're in a strong market, in a strong sponsorship team, you should be pretty safe. Really, it's really pretty good.
And the more deals you look at like that, versus just, look at the sponsor, you'll learn as you go too, which, you'll be able to look at a deal within 10, 20 minutes sometimes after you've had 20 of them and you'll know right away. So
Well, yesterday I have an investor it's a new investor to me, and he's going to come into my Florida deal. But he brought another deal to me. He says, Matt, we've been talking on the phone for the last few weeks or whatever, and Zoom like this. And he says, there's this other deal I really want to invest in. Will you take a look at it? And I told him earlier, I said, you don't have to invest with me. And if you have another deal, because people bring deals to me, and we spent 45 minutes reviewing the underwrite, and I said, okay, this is good. This is good. This, they say they're going to do this in 3 years. Their business plan is 3 years. You probably can do that. I mean, we're doing it today, but I don't know. I would plan for a 6 year. Don't expect it to get your money back. But we reviewed the whole things, and you know what? And by the way, one of the sponsors was somebody I knew from 4 or 5 years ago. A wonderful guy. I said, first off, I give this guy a thumbs up. I personally know him. I've known him for 4 years, and the deal looks really solid. Other than the fact that they say they're going to do this in 3 years, plan on 6. Have your money time. So I helped him out. He put 75 grand into somebody else's deal. Yeah. That's what you want. You want to be able to do that for your investors, because even if he doesn't come into my deal, I did the right thing. It's karma. It's going to come back some way, somehow. Exactly. And I want to make sure he's protected. Now, I've had people bring deals to me and they've said, hey, and I've looked and said, no. Here's the 3 things. First off, there's 20,000 people that live in this city. There's one employer. If something happens to that employer, there's vacancy out. It's going to be crazy. Right. And things like that. But they were being sold a bill of goods. This is a great deal. I said, I would not invest this in myself. Go for a bigger metropolitan area. Look for these things. So we're always, and I know you're the same way, Andy. You would never steer anybody the wrong way. Right. We have that expertise that they don't have. So I want to make sure I'm protecting them.
Exactly.
That's an example.
Them, at the same time. Exactly.
Yeah, exactly.
That's awesome. Now, besides, I guess probably investing in real estate earlier, if you could look back to your 18-year-old self, is there anything else you would, tell him or, warn him about?
It would be the obvious, invest in real estate earlier. Right. And we did. My wife and I used to flip houses once we first got married, and then we had kids, and we had to stop doing that for a while. But the other mistake that I made, and then this was in the 80s, I put all my money in 401k. Oh, you can. The company matched 6%, and then I put in. I go up to 20%. I'd max that thing out every year. Now I'm like late 40s, like, I got all this money sitting in the stock market. I can't touch it. I can't do anything, but I'm going to retire. I can't touch it without paying 10% penalty. I was in the highest tax bracket. So I would say if you're in your earning years right now, always match your employer's percentage. That's free money. Yeah. Above that, you should invest it in, even if you put it in a Roth where you've got access to it, put it in something else that you have access. What if you outperform and you do really well and you invest in real estate and you 2x your money every 3 or 4 years or 5 years? You have access to it. Then you can compound it. You can't do that in a retirement 401k or an IRA. You just can't. You're not allowed to do it. So that was my biggest mistake. So going back, I would have matched it, and then taken that and put it in something else. Even if it was in the stock market, but not in an IRA. So I could capitalize. Okay, it's up real high, sell it, and I go do something else with it. Yeah. That was a big mistake I made. So don't max it out. Just match the employer. That's my advice. Yeah,
that's great advice. And you learn along the way too with your own money. So you can kind of, it's great. I'd recommend it. I don't really invest in stocks either, so mine's pretty much 100% real estate, but I'm biased. So,
but it's still retirement funds, and my wife's got some stuff that I can't pull out. It's some annuity thing from one of her employers. So it's just forced. I can't get it out.
Yeah. If I had a match, I would do it too. I agree with you totally.
Yeah. Just match
take free money.
Yeah. You should always match, but don't go above that. Yeah. Okay. Do something else. Listen to Andy's show and learn what else to do.
There we go. Yeah. Perfect. So last question. I know we're on a time crunch. So if you could step into my shoes for the interview, what's one question you would ask yourself that I did not ask you?
Boy, we covered so much, Andy.
I know.
I think it's just vetting, educating yourself. Because once you're educated on it, doesn't seem so risky. It doesn't seem so scary once you really understand it. So I think it's just, education, and we've kind of hit upon that. And then listen to the show. You're getting people that have done this. I made mistakes.
Right.
I've shared some of them with you.
Yep.
I'm not perfect, but I've learned from those and learned from other people's mistakes. I guess that's the thing, is learn from other people's. Listen, consume content, listen to podcasts,
Mhm.
read books and things like that. I mean, it's really important that you educate, and then you're comfortable. The
Right.
comfort level.
Yeah. Yeah, as long as it's people that are, industry experts like yourself and have done it, that's the best way to learn, I think.
Exactly.
Now, how can people contact you? Social media, what's the best way for them to reach out and get a hold of you?
Go to HansenHoldings.com. We've got lots of information there, educational stuff out there. If you want to set up a time to chat and learn more about it, there's an opportunity to schedule there. But HansenHoldings.com, simplest thing to do. Lots of content out there. You can read through at your leisure, get educated on it, and then just take action. That's really the thing, is don't sit on the sidelines. I know there's people are concerned that, the stock market's down. Well, you think it's down now?
Right.
And so people are afraid to pull the money out. Well,
Yeah.
it could take 10 years for it to recover. Who
Right.
knows? Or it could take 3 or 4 years.
Yeah.
What could you have done with that money and earned more money on it? I
Mhm.
think that's when people need to realize, they're saying, well, I'm going to take a loss. Well, you're going to take a loss either way, probably, because you're
Right.
not going to have the value of that money because it's going to go down, probably.
And we don't even know if this is the bottom. It could be further top from here. We have no idea.
No clue.
So, well, now we're into our 5 to Thrive, which is my favorite portion of the show here. So this is just a word association game. I'll just rattle off 5 words and just give me the first word or phrase that comes to your mind. The only thing is you cannot repeat your answer twice.
Got it. I'm ready.
All right. First one, multifamily real estate,
Wealth,
passive cash flow,
income,
wealth creation,
real estate,
leverage,
loans,
and Hansen Holdings.
fun.
I like it.
I'm a fun person to work with, as you know.
You are.
Like,
I agree.
Okay, it's not going to be stodgy or anything, and really, I want people to educate and enjoy it. Because you're going to be tied to this person for 6 years. If you're
Right.
investing with somebody, just know that it's somebody you know, like, and trust.
Yeah.
So I would say know, like, and trust.
Yeah.
In addition to fun, but really, you want to enjoy who you're working with. Life is too short to
I
deal with
agree.
somebody that's not fun.
Yeah, this was a serious one for us. Usually we're laughing and joking back and forth. So this one.
I went serious on didn't. Sorry about that. I'll take it back a little. It's
Cool.
a pleasure.
Well, thanks, Matt. I really appreciate you coming on.
Thank you so much. I really appreciate it. You're doing good things out there. Andrew. Appreciate it.
Thank you. Appreciate that.